Welcome to your final financial stop, where today we're going to be talking about interest rates, what they are, how they work, and how it's affecting your wallet. If you'd like to learn anything from the video, please share, subscribe to this channel. If you have any questions, follow my Twitter or leave a comment down below. I'd be happy to reply. And lastly, follow my Patreon if you want to further learn how to lower your interest rate and put your money into compounding interest investment vehicles. Interest rates are the payment on top of the principal amount paid to the lender for the right to borrow. This is usually a percentage expressed annually and broken down into different ways. Interest rate depends on the terms of the loans, like what type of loan it is and how long it'll last. Interest rate also depends on your credit score, depends on the federal regulated interest rates, and interest rates can change with late or delinquent payments. So today we're going to be looking at prime rate, discount rate, variable, fixed, APR, simple, and compound interest. The prime rate is a starting point for interest rates. The prime rate is typically lower than most interest rates given to customers, but is offered to some creditworthy applicants. The prime rate is not an exact number. Each bank has the ability to set their own rates, but they typically go with the largest banks out there. Today, the prime rate sits around 3.25%, about 3% over the federal funds rate. And the federal funds rate is typically kept between 0 and 0.25%. So when the federal funds rate changes, so does the prime rate, and so does your variable rate. And don't get the federal funds rate confused with the discount rate. The interest rate is based on a loan borrowed from the Federal Reserve. The federal funds rate is the interest charge that banks must pay from borrowing from other banks. The discount rate is typically higher than the federal funds rate because the Federal Reserve wants banks to borrow from other banks. Plus, the Federal Reserve has to list out all the names and amounts of banks that borrowed from them. Banks don't want you to know that they don't have enough money. There's also variable and fixed interest as well. Variable typically moves with the prime rate, and therefore it's harder to calculate, but because of that risk, the rate is typically lower than the fixed rate. So if the rate never rises, you pay less than that fixed amount. The fixed rate is easy to calculate, easy to understand, and consistent. And if you have a steady income, it's easy to budget. Then you have APR, or the annual percentage rate. This is the annual cost of the loan, including fees associated with taking the loan out. For instance, credit cards offer APRs because you roll over a balance from one billing cycle to the next. There are also balance transfer, penalty, cash advance, and mortgage APRs, and many, many more. Understand that all APRs are different and pay attention to the one that'll benefit you most. Then you have simple and compound interest. Simple interest is a fixed percentage of the principal amount that was borrowed. So it's the principal amount multiplied by the interest rate and then multiply that by the number of periods. Compound interest is a little more difficult. You add 1 to the annual interest rate, then power that sum by the number of periods, multiply that by the principal amount, and then subtract the principal amount. The U.S. Federal Reserve overlooks monetary policy and changes the interest rate based on inflation, wages, unemployment, and much more. One of the best ways the government does this is by buying or selling U.S. securities. When they buy these securities, they flood the banks with money, and then the banks have more available to loan out, therefore making it easy and lowering the interest rates. The more money that's printed and distributed, the higher inflation rises, and because it's too easy to lend money, interest rates will often increase. So it all boils down to the supply and demand of capital. When there's an increase in demand or a decrease in supply, the interest rate will typically rise. And there are many ways you can lower your interest rate. For example, negotiate with your credit card company. But make sure before you do that, you check with your credit history, you have a good on-time payment record, and you've compared other deals. Most 15-year mortgages have a lower interest payment than 30-year mortgages. But depending on your credit score and other variable factors, this can make you pay more in the long run, so always do your research. And some lenders offer a percentage off when you auto-draft your payments. So find a stable account and put your money into it that rewards you compounding interest. For example, savings accounts and money market accounts typically offer 0.06%. There are online banks that offer 5%, but my favorite place to put my money is dividend stocks. I find a large company with a lot of growth value. Every quarter I'm given some money for owning some shares, and then I put that money into it. So thank you for joining me today. Share, subscribe if you'd like to learn anything from the video. Follow my Patreon if you want to learn more, and follow my Twitter. If you have any questions, ask me. I'd be happy to reply. Thank you for joining. A quick reminder that this is not financial advice, and any information found here should not be substituted for information coming from a professional financial advisor. And I am not responsible for any information that I do or do not provide. Every investment has its risk, but you can also be rewarded heavily. So please do your own research.